Good morning, everyone. And as Laszlo said, I'm Colin. I'm an associate partner at Kearney, based in London, and one of the co-authors of the study, which you've all got a copy of today. I mean, as Laszlo says, we're going to be talking a lot about the internet today, but it's also very good to be in person at last and making the best of both worlds as we're online today as well. So just a reminder of the value. Yeah, okay. As Laszlo said, this is a study we actually first wrote back in 2009, the original framework that we developed back then. We refreshed it in 2016, and this is now the third iteration in 2022 that we launch. The aim of this study throughout these times has always been to try and present the facts and be the give an objective view of how trends and dynamics are taking place within the internet value chain to inform the discussions that many of you will be having and part of, and which we'll discuss in the panel discussion afterwards. So today we'll just give, you've got the big thick report, but today we'll just give you an overview and some of the snapshots and some of the insights into some of the key trends that we see happening now in 2022, which is a very different internet to the one we first started with in 2009. So just to set a little bit of context, I mean, it's not news to you to know that the internet is growing rapidly, but it is interesting just to reflect quickly on the numbers here. On the left, you see the global internet penetration. It's been rising rapidly and consistently for at least 15 years. And actually, it's not slowing down. It's still only about 60% of the world's population that have regular users and have regular access to the internet. So there's still a lot to do for the industry and a lot of growth still to come there. Also, just in terms of traffic, again, I mean, that's just been growing phenomenally. I think it's more than 4 times what it was 5 years ago when we last did this study, growing at well over 30% every year across both mobile and fixed. And what you can see is predominantly what is driving that, the bulk of it, almost 80%, is video and streaming traffic now on the internet. One other thing we looked at as well in previous studies, we used to do a sort of league table of the most popular websites, just as a sense of how concentrated is the internet, and also how did it change between 2009 and 2016. Now, obviously, this time that metric's no longer useful, because most of what the internet is used for is not going to websites to access information or services. So we've sort of changed that, and just looking at often quoted study here. This is from a Sandvine report, but looking just at traffic, it's interesting to see that just 6 companies now represent almost 60% of the traffic on the internet across a variety of services. Obviously, they offer a portfolio of those, but that's quite an extraordinary level of concentration for a global internet that we think of as being very diverse. And obviously, there are many thousands, hundreds of thousands of different services available on the internet, but it shows you the level of concentration for the biggest players. So moving to the value chain, if I just quickly recap in terms of the framework, essentially this has been the same across these 3 reports. We have the 5 segments, so we break this down into, on the left-hand side, sort of content rights. This is some of the content that's used and accessed over the internet, some of these services. The online services, which is what many consumers will think of as being the internet. This is what they access, whether it's retail, videos, audio, gaming, search, the whole host of services, social media, of course, make up those online services. There's a third, that middle segment, some of the enabling technology and services that works mostly in the background to make all of those services work, and that covers things like payment platforms, the online advertising, the mechanics that work in the back of that Internet of Things, and as well as design, hosting, and many cloud services that host these services within the internet. The third sort of red column there is the internet access, the connectivity that we all use, whether that's mobile or fixed home broadband, maybe satellite. That's growing, obviously, but still very small means of connecting to the internet. And on the right-hand side, the actual devices that we use, and in the original internet, that would have been PCs and maybe tablets, but obviously now it's predominantly, well, it's phones, but it's a whole diverse set of things like connected TVs, other smart home devices. They're all connected to the internet, and we capture those there, as well as the software and systems that support them. to making all of those work. So that framework is how we think of this. We've made a few changes since last time, just highlighted, but relatively small. Obviously, cloud has really boomed over the last 5-6 years. And we had that last time all grouped as one, but we've separated that into the sort of software as a service, which is an end service in itself, and then the infrastructure and platforms that are used by many cloud companies, or others use those cloud services. When we size and look at the value chain, we look at each of these blocks in terms of the total revenues. So when you see the numbers on the next page, it's the total revenues flowing through any one of those segments. It's not, in economic terms, the value added by those. That's quite a different analysis. The only exception to that would be the e-retail and e-travel, where we take the gross margin of the providers, not the total transaction. And same for gambling. Here it's not the amount wagered, it's just the sort of platform take. But that's how we size the overall internet value chain, as we call it. So moving to the numbers, as you see on the right-hand side, the total now is $6.7 trillion of revenues across all of these services. That's almost exactly double what it was when we last looked at this. And that represents, still growing at 15% per year across all those segments. As you see on the right-hand side, the actual CAGR of the individual segments, they've all grown, at least, 6% is the lowest, but some of them growing quite a bit faster. And you see that online services, the black area, is now 57% of the total chain. So that's grown. If we go back to 2009, it was 41%, but greater proportion of what people spend on internet-related services as a whole, or accessing the internet as well, is now going to those services, which is probably natural as these things evolve, mature. Once you're connected, there's many more things that people can do on the internet, and whether that's advertising driven or subscribing to services. It's interesting to notice that the fastest growing in pure percentage terms is actually content rights. You see 23%. I think that's one of the shifts that we've seen over the last 5 years, that the sort of value of movie rights or sports rights specifically for internet distribution have become much more important. In fact, more and more content is commissioned by and developed specifically for internet distribution, whereas probably 5 years ago that it would more have been an additional side revenue for things like movies that were still primarily made for cinema. So that's changing, and we see that growing quite fast. It's still obviously a small amount. The other one, perhaps to comment quickly, just user devices, it's low. Obviously, people still have many devices, but with the expansion of smart connected devices, many of these are sort of smaller, lower value. Could either be mobiles, but also the connected home type devices. So that sort of shows a lower growth just in absolute value terms, but still growing and definitely growing in volume terms considerably quicker than that. The other thing I'd mention just in here, you see the telco segment, the red, the internet access, that's grown at 11%. One thing we talk about a bit more, explained in the report though, that's essentially substitution. So that's things where they would get non-internet related services, whether that used to be the old voice, still quite a lot of minutes, or private data networks. More and more of those are now migrating to internet-based networks, and therefore that growth they've seen as an equivalent loss in terms of other revenues. But from a pure public internet access, it is obviously still growing quite healthily. Just trying to size all of that. This shows the relative size of each of those segments and some of the breakdown. You see immediately just how important e-commerce is. The internet has for a long time been a great way for people to buy and sell and connect buyers and sellers for a whole range of services. In fact, almost probably every type of service product that you can imagine, I'm sure you can buy or transact over the internet. A lot of that probably replacing transactions that would have taken place offline many years ago. But obviously that's big. But when you look at that sort of middle column, there are many new services there that simply could not have existed before the internet. Whether that's video streaming or online gaming, multiplayer type gaming, effectively depends on the internet to exist. You see, mobile access is still quite a large portion of this, and still a lot of spend in relative terms on the end devices. That's also quite a big segment there. So that's the numbers that sort of underpin all of this. Just looking at some of the key trends and trying to draw out a few insights. Three key things I'll just run through quickly that we see happening here. The The largest players that we see, expanding across the value chain, I'll talk about that a little bit more, moving from their sort of home services. I'll also talk about that, the sort of balance between paid for and advertising driven services. That's always been an interesting dynamic within the online services, how they're funded and paid for and earn their money. And obviously digitalisation, particularly for the enterprise and companies, is a big trend, which is ongoing and has a long way to run, I think, still. So just this idea of the companies expanding across the value chain. So obviously two key dimensions here. The first one, as you see on the vertical, many companies that were quite strong in one particular segment, many of those are looking to offer more services either to their existing customer base or perhaps trying to acquire new customers by moving. So examples here, would be, obviously Amazon started in retail, but now they offer video and some of the other services. Facebook started in social, but they also offer messaging, have a big marketplace retail service. So expanding up and down that sort of vertical area, offering more services. And the other aspect, which some of the players are largest players are looking at, is expanding really across the value chain. So moving into the devices and the enabling services, and even right through to the buying, rather than buying rights or services to broadcast, for example, for media services. Amazon just bought MGM Studios instead and thought, well, let's make it ourselves. So moving to that far left-hand side. So, we see those trends playing out, and I think as the metaverse comes along, it's still early days and we have to see how that evolves, but, I think that strengthens this, that it's not just one service at the end, but it's some of those biggest companies will want to own a full ecosystem to be able to offer a fully integrated metaverse type experience. But it's still to be seen, I think, just how interoperable or separate and parallel ecosystems evolve. But obviously, however that evolves, it's likely to be very different to the open internet that was the original sort of 20 years ago of connecting anybody anywhere to all the same services and a great leveler. Here, we could see different sort of diverse ecosystems emerging. Just a few examples of how some of those players have expanded. I think if you look at Alibaba, which is the second from the top left, you see that they've really moved into every single space or launched some form of service across each of those online services. We see that in some other countries. I think Grab is another example of kind of super apps which are becoming predominant in Asia and India and others, and Paytm, where normally they seem to be built on, they have a transaction, some sort of payment platform, and then can add, or other services can build into their app, many other services, whether it's travel, food ordering, commerce, buying tickets. A lot of those things can plug into there, or subscription type services once you have the payment platform. So we see that happening, and Alibaba is a good example of that. Apple's a good example of one company which obviously came from the hardware side, well known for their devices. I think if you look at their most recent results, at least 30% of their revenues now come from services. So they've built onto that and now sell through to mainly in that same target market, many other services. So they've expanded more to the left, and obviously right through they have their own video services and things. And Amazon and Google are both, they've also expanded from a core area of strength and now move into many different areas, right through from hardware and operating systems, and as I mentioned, through to the other side of buying content rights. The second area, as I mentioned, that we'd just highlight, I think, is the proportion of these online services, whether they're paid for directly through subscriptions or whether they're funded by advertising. And there's always been a sort of expectation, I think, that, eventually advertising has been moving from offline to online, so there's a huge growth there. But eventually there's a natural cap. There's only so much more advertising that can shift online. And that because the internet, these services are generally growing faster than overall advertising spend, that much of that growth would come from paid for services. Now, I think that's true in some segments, but what we see here in the data, perhaps a little surprisingly, certainly to what we'd expected when we first looked at this, was that proportion has stayed largely the same balance. Roughly 61% are still paid for services, whether by consumers or business, and around about 40% are advertising paid. But obviously, very, very different by the service. So you see search and social media still very much advertising paid for. Gaming is about the most balanced, 50-50 almost. But that spans things from casual gaming, free games, with adverts, or maybe in-app purchases which generate revenue, through to full subscription-based type services and online gaming platforms. And then on the right-hand side, you see some of the others which are predominantly paid for, cloud-based, software services. Enterprise are always going to be paying for many of those, and gambling is obviously largely paid for in hard cash. And then the third trend is just digitalization. So looking particularly at enterprises in particular, most corporations of whatever size, from small to medium to very large, still have large legacy, or what they perhaps might not even call legacy, but big IT stacks, very much customized applications run on their own hardware. But there's a big trend of that moving into the cloud base, or even away from standalone applications completely to whole cloud-based services, which is an ongoing trend that they're shifting that load from on-premise into the cloud. But that puts greater load on the networks that are carrying all this traffic to have the capacity and also the reliability, because that's one key thing here, is that if you can't access the cloud, then you can't run various corporate applications or access them. Internet of Things is still growing. There are still many more connected devices generating much more data, and often continuous streams of data. So things like video or cameras, you might have artificial applications monitoring those. That takes a lot of processing, and puts a lot of load on communication. And obviously just more and more connected devices, just generally that grows. And most of those need to be always on sort of connectivity to function. So the result of all of this, no surprise really, that there's definitely a need for investment in more network capacity. There's simply a lot more traffic every year, and networks need to grow and increase their capacity accordingly to handle that traffic. But also capabilities. I think that as networks get more intelligence, you need more functionality in there. Then the networks themselves, whether that's edge processing or high density type applications, there needs to be large investment in that. And 5G provides some of that, and there are many other developments there that will go into the internet networks to be able to provide that functionality and those new more innovative, feature-rich services in future. And then if we just move, final section, into the financials. What does this mean for those companies that are participating in this, and who's sort of making money out of this, and how are they doing that? On the left-hand side, you just see the total shareholder returns. These are groups of companies that we've done a sort of weighted average that, how have their shares and their dividends all performed, indexed back to a common point in 2016. The first thing that's striking, obviously, the huge volatility in some of those segments, and also very different outcomes depending on the segments. And they're in different sectors, and they face different risk profiles. This is not necessarily unusual, but interestingly, the user device has grown the most strongly, almost 6 times. Some of those companies, whether that's Apple, Samsung, or others, and not just phones, these could be many other connected devices, but returning, strong growth there. Social media has done quite well until recently. Obviously, there are question marks around the viability of their business model, advertising, and the ability to track individual users, which has always been their sort of USP that's attracted more advertising to them. And that's obviously in recent months raised questions over some of their business models. They may find solutions to them and get back on track, but interesting question. And you see the internet access providers, which are essentially the telcos at the bottom, very steady, but very low, and consistent returns over this period, considerably lower than the others. And just on the right-hand side, just looking at a more specific metric, the return on capital employed, relatively consistent for all areas, but very different. The user interface is perhaps an outlier. This is as I said, Apple, Samsung, it's not a capital intensive sort of business model really. They outsource most of the manufacturing things. That most of their return comes from the branding and the patents. So they're naturally going to have a higher return on capital. But some of the others are more asset intensive. And obviously what is striking is the internet access providers, less than 10%, and if anything declining, which is most striking there. Just going a little more specifically, the five black lines just show you a breakdown of some of those companies. So that first group, on the left, the first two companies, social media and search. You see they're spending, CapEx pretty rapidly as a percentage of revenue, up to some of them over 20%, but earning good returns, good return on capital there, good EBIT margins. I mean, it's a little bit hard to generalize, but I think part of this is driven, they have, those are sort of businesses that have strong network effects, and it's harder for others to come in and see nice margins, but it would be hard to start a social media company tomorrow to win some of that. So I think they're benefiting from that. You see a second group of online services though, around video streaming, e-commerce, and some of the cloud services, where these are much more sort of lower margin type businesses, where scale is absolutely key. And the likes of Amazon growing in here, it's typically low margin, but they do it on such a large scale that it's viable. But you see the effect that has on their financials, and similar for the other ones. But they have to keep, building that scale and really squeezing and focusing on margin to make their businesses work. And the ones who succeed do very well, but it's a tough area to compete in. The third strand you see there in red is the telecoms companies. So again, investing. And there is a range, there's quite a large spread when you look across this, but investing CapEx at pretty high rates, around about 15% on average. Again, some of those might even be above 20% CapEx as a percentage of revenue. And seeing reasonable returns, as we said, on the low single digit return on capital, reasonable EBIT margins. So it's viable, but it's not as high as some of the other returns that we see. And then, as I mentioned on the right hand side, the user interface, I mean, low CapEx modeling, but typically high margin because of brand and patents and other, classical sort of things that drive good margin businesses, if you can succeed in those businesses. So what does all this mean in the end for the telecom companies? I think, and the operators in the middle. I mean, what we see is probably essentially a two-sided squeeze. So in terms of the network assets at the bottom, because they're looking to drive increased efficiencies and sort of increase their margins where they can, there is a move to sort of share assets, whether that's through joint ventures or even sell them. Mobile, obviously selling off the towers to towercos, who can then build better scale and get better margins. That's certainly a feature happening, and we see that to some extent in some markets, also on the fiber and on the fixed side, where you have the emergence of netcos, or at least wholesale models. So you have a wholesale operator who tries to build scale purely in the infrastructure, but not get into customer operations. And they're very often funded by the sort of infrastructure investors or pension funds. So they see that as an area they're moving into, and the operators becoming a little less asset driven, and withdrawing from that to some extent. And similarly on their core services and their IT and data centers, again, many of them have built, almost all operators will have large data centers to some extent, either for their own use or for their customers. But again, even the biggest ones are finding it's hard to build the scale that you need to run those efficiently. So more and more, they're sort of withdrawing from that to some extent and moving some of those services to the large global data center cloud providers. So reducing their asset base again there. And then on the top line side, the online services, many of the services that the telecom operators have traditionally sort of around communications or media and entertainment, and also the business services that they sold, are now becoming online services, somewhat disconnected from the network or independent of the underlying network, whereas previously they would have been very much integrated. So you see online services moving into many of these areas and taking some of the revenues. And that leaves the telcos with the orchestration and putting all of this together, and integration, and also running the customer operations within their local geography, within their customer bases. But what this means, just thinking back to the financials, is that they still have to invest just as much in the infrastructure, as we said, for the capacity and capability reasons, but the returns they're earning that justify and pay for that investment coming from a sort of reducing service pool and effectively revenue pool. But most of these changes don't really change how much they're needing to invest. So it's a long, slow, steady move in this. None of these are radical step changes, but it is a concerning trend, I think, in terms of that increasing need for investment and yet a decreasing sort of revenue pool to fund it from. So that's where we see it, without being too gloomy for the operators, but that's where we see it evolving to. That was the last slide for this section, just in time, I think. Any questions on anything? Take a breath. I think there's a microphone somewhere. You don't want to be first to raise the hand? None? I hope it was so clear that there is no question. That's fine. Is there any online that you want? None? Okay. Well, thank you very much. I'll end there. Thank you.